Hi there and welcome to the weekly roundup for the week ending Friday the 23rd of October. We hope you're enjoying these weekly roundups and please do subscribe to receive regular stock market content. Please also feel free to pop up any questions you might have in the comments box below. We would love to hear from you, and also we welcome you to follow our free market sector reports on tech, banking and even IPOs. Do so by using the link in the description box below. So this week on the market, we've seen the indices trading on the back foot in Europe. We've got the FTSE looking to end the week around 1.2% lower. DAX is looking to shed around 2.2%. The big theme here has been rising coronavirus numbers, tightening lockdown restrictions and rising fears that this is going to derail the very fragile economic recovery that we've seen so far. PMI figures out today have backed up this theory we've seen. In the UK, whilst business activity is actually still in expansionary territory, this has actually slowed, particularly even in the service sector, which has slowed more than expected. Over in Europe, the picture is pretty grim as well. Business activity as a whole has slipped into contraction, whilst manufacturing is actually still outperforming the services sector. So this is the sector that's really been hit by lockdown and tightening COVID restrictions, has slipped deeper into contraction territory. Also, a big market this week has been Brexit. There have been some developments. So at the beginning of the week, Boris Johnson walked away from negotiations, citing the lack of progress in talks and saying that the EU really needed to have a fundamental change in approach to talks. Meanwhile, the EU were happy to blame the UK for the lack of progress. However, there was a change of heart midweek and both sides are now back at the negotiating table, and that boosted the pound. We saw the pound jump around 1.3% on Wednesday versus the US dollar on hopes that a deal could still get pushed through before the end of the transition period. This has obviously added uncertainty to the general feel for the markets, and that's been playing out in the equities. It's just adding to that level of uncertainty of the will they, won't they actually get this deal done. Over in the US, uncertainty has also been the name of the game. The US fiscal stimulus talks, this has been sort of driving the US stock markets up and down all week as we get progress reports, and then they haven't really made any progress. So really we can see that investors are absolutely hinged on this idea of whether the US will receive additional fiscal stimulus before the US elections, which are now under 2 weeks away. So it is looking a little bit unlikely that they will get this done before the elections. As far as US indices are concerned, we are seeing those fall lower across the week. S&P is down just 0.8%, whilst the Nasdaq's looking to trade around to finish the week around 1.4% lower. Now, it's been a really great week for companies reporting. We've had a lot going on. Netflix, they reported they've dropped 8% across the week with some disappointing numbers. Now, whilst they performed spectacularly in the first 2 quarters of the year as the classic stay-at-home stock, they have been slightly more disappointing in the third quarter. Subscriber numbers only increased by 2.2 million. Wall Street was expecting to see an increase of around 3.4 million. And let's just compare this to the first 2 quarters where they recorded 10 million and 16 million new subscribers. So this, third quarter was a massive disappointment in that respect. Also, there are concerns over saturation in the domestic market, and what we're seeing is as competition is also hotting up and as sort of the economy is reopening there, then people are sort of moving away from that stay-at-home stock. Another reporting from Tesla. Now Tesla, they are actually down 3% across the week, which is interesting given that they had such strong numbers. Now Tesla reported a solid earnings per share of 0.76 cents. That was above expectations. expectations. And also the fact that they've been profitable now for the 5th straight quarter is really just calming and soothing those underlying concerns over the profitability of the company. So there are sort of hopes rising that with a 5th quarter of profitability that Tesla could be considered soon for the S&P 500. Another stock reporting, Barclays. This is the first of the big UK banks reporting, and they smashed expectations. So they reported a pre-tax profit of 1.1 billion. This was twice the expected 507 million that analysts had penciled in. Now what we've seen, not only has Barclays got a very strong investment banking branch, so that's really benefited from the volatility in the market, but also bad loan provisions have also come down. They weren't as bad as expected. We had been expecting to see sort of £1 billion worth of bad loan charges, and in fact that was actually only 600 million. So that really does bode well for the remaining banks that we've got coming up reporting next week: NatWest, Lloyds and HSBC. Thanks very much for watching, and please don't forget to subscribe, and as I said, any questions, pop them in the comments box below. Have a great weekend.